Markets may be open today. Yes, we are trading, but what really matters in the next 48 hours is one match. India versus Pakistan. And when it's India versus Pakistan, what do we say before the match and what will we say during the match? Jeetega bhai jeetega.
India jeetega.
Jeetega bhai jeetega.
India jeetega.
अरे न्यूज़रूम की आवाज क्यों नहीं आ रही है? जीतेगा भाई जीतेगा.
India jeetega.
न्यूज़रूम के साथ एक बार और. जीतेगा भाई जीतेगा.
India jeetega.
Okay, now that is the spirit at the ET Now and ET Now Swadesh newsroom today. Jeetega bhai jeetega, India jeetega. So the number which really matters, well, it's the cricket score. It's a moving average, but that is the spirit which we want to wish Team India. Now, भाई टिकट किसने बोला नहीं मिल रही है? वामाक्षी के पास तो टिकट है. I think you got ticket. Yes. You know how many jealous people are around you when you have the ticket. Yes. You actually have the ticket.
Yes.
But you're not going. You're giving away the tickets, right?
No. I'm very much plan on going.
Think again. Vamakshi has the tickets, guys. Okay. Even I don't have the tickets. So you should say it loudly.
Jeetega bhai jeetega.
India jeetega.
Now here's some interesting data. Well, on ET Now it's numbers, and the number cruncher Sharad ji is here, and Sharad is going to tell us the track record. We always look at history to understand that what is India's track record what's India's track record at World Cup against Pakistan. So why don't you just update us?
Well, Pakistan have never won against India in a 50 Cricket World Cup. So head to head 7-0. 7 times India has won, and hopefully it's going to be 8-0 as well. And after 7 years, Pakistan is coming to India for this tour. And if you look at the World Cups, 2 World Cups India has and 1 World Cup Pakistan has. But overall, the feeling is the same. Jeetega bhai jeetega.
India jeetega. With that, it's back to the studio, and I'm sure Aisha and Avan will say the same in the studio. Jeetega bhai jeetega. India jeetega.
I'm sure India jeetega, and while the match is tomorrow, and we're all envious of Vamakshi because she didn't even get a flight ticket. You know that, Avan? She's actually training it to Ahmedabad for the match.
Whoa, Vamakshi, that's really something. But you're the envy of everyone in the newsroom because, guys, this is going to be huge. Everyone's eyes are going to be rained on all the excitement because it's going to be one of the most anticipated matches, Aisha. India-Pakistan scheduled tomorrow. All eyes on the Narendra Modi Stadium.
Absolutely. And after India's splendid performance against Afghanistan earlier this week, expectations from the men in blue are pretty high. And of course, our first defeat of Australia as well, which kick-started the World Cup series this time. India and Pakistan have gone up against each other 7 times, by the way, in World Cup ODIs, and India have emerged victorious in all encounters. So hope it's 8 times lucky. But unfortunately, victory is going to evade us on global markets today, or equity markets today, because it's pretty much a soured sentiment across the street. What's going to be the big dampener? Surely it's going to be Infosys to start off trade, and we'll talk about that in greater detail in just a short while from now. Just looking at the global market sentiment as well, it's been a weak handover coming in from the US equity markets as well, which overnight have seen quite a bit of ebb off coming in. For us as well, we were just about very, very range bound yesterday, and a very tight band from the highs to the lows of the day with a negative bias, closed in just circling around that 19,800 level. That said, this morning, the SGX Nifty, or rather the GIFT Nifty, is indicating a backtick of over 100 points. So seems like today is going to be definitely a step back. As you can see on the Asia screen as well, we're not going to be alone in the weakness today. It's pretty much across the globe. It's pretty much indicating that it's going to be a weak start for us on all counts. While yesterday, of course, IT was clearly one of the big losers, led by TCS. Autos managed to gain for a 3rd consecutive session. The small cap index continues to near and scale all-time highs. But Aman, looking at the global setup, that's not going to be quite the case today.
No, it is not. Just take a look as to how things are panning out across the globe, and it's red across the screen. That's what you're seeing overnight in terms of the kind of traction that the major indices witnessed, ending in the red, down over 173 points. In fact, on the Dow Jones, you had the S&P 500 as well as the Nasdaq that slipped in trade. But despite this move that they witnessed last evening, by the way, they are on pace for weekly weekly gains. The S&P 500 is up about 1% or so, at least so far in the week gone by, which would mean that it would be the third positive close coming in the row, especially when it comes to the Nasdaq. Lots of big earnings as well that kicked in terms of JP Morgan, Wells Fargo, BlackRock, etc. It has been a little bit disappointing in terms of the numbers, the potential rate hike, and concerns, of course, over the ongoing Israel-Hamas war, which could threaten global oil prices and supply. That being said, what's happening with Asia this morning? Well, you do have pretty much piggybacking on that sentiment. It's been a sea of red pretty much for the Asian screen this morning. You've got it across the board coming in, the cuts coming in and really trading pretty much in tandem with what the rest of the globe has thrown up. What's the GIFT Nifty indicative price this morning, given the fact that in yesterday's trading day, we managed to wrap up absolutely flat. We didn't manage to hold on to the 19,800 mark. It was the broader markets, in fact, that took leadership, up a meager 12 points. That's the indicative price on the GIFT Nifty, around 19,687. But the stocks of the day, Aisha, and you started off with it, it's going to be IT all the way.
Yeah, it's going to be IT all the way, as though TCS wasn't enough yesterday. Today, you've got HCL Technologies, which of course has been a mixed bag. But I think the problem child, Nikunj, is going to be Infosys today. Back to business. Tomorrow is the match, but today we'll have to deal with a loss for Infi.
It's a
the
no
fact that
the
fact that they've actually brought down their upper end of the guidance, that's going to not go down well with the street.
So Aisha, bad news coming from Infi is not new news, but bad news coming for 2 quarters in a row.
Yeah.
At a time when they are getting fat orders, it just tells you that there are 2 ways to look at IT. One, is the scenario really bad and terrible? If the scenario was really bad and terrible, then the stock, then the company would have not got large fat orders in terms of the order booking. But the orders which they've got, I think they will take time for those orders, in a sense, to kick back into the revenue line. So what we are looking at a very poor second half of this year. But in terms of an assumption, it's even worse than what brokerages, in a sense, were anticipating and expecting. While the bravehearts would say that FY24 will be a tough one, FY24 will be a year of recovery, and that may really hold true. But in the interim, because the stock has seen a run-up from the recent low, which is from the April low of about 15-20%, that rally, in a sense, will get challenged. Now, there are two factors at play now. If you are taking a slightly longer term view, which is you are ready to look beyond FY24 and beyond FY25, then of course the base effect and the cyclicality would be at play, and FY25 and FY26 could be comeback years for Infosys. But FY24 is just where they've really got their positioning wrong. And Infosys has always commanded a premium for getting the cycle right. And this is where, in a sense, markets are really questioning that, okay, if orders are coming, when are the orders coming? And if orders are not coming, then, what, in a sense, prompted you to come up with a guidance last December, and then you've come out last Jan, and then you've come out and slashed those guidance very, very aggressively. So in the near term, I think the stock will underperform. It has seen a run up. We've not got a very confident, commentary from HCL Tech as well. So IT becomes this sore point for the market now, and that, in a sense, which was the outperforming contra sector, I think will remain the contra sector.
Yeah, and especially looking at the commentary as well, it seems like a very morose one, if I can call it that, right? Not just the guidance cut, but they're saying that discretionary spends and decision making has reduced. Infi is what I'm talking about. They're saying that some deal ramp ups are timed at the fag end of the year. Don't think we will go to campuses this year. So it's all indicating and hinting towards a weak second half and a lot of gloom and doom, if I can use that terminology.
So, if you just look at the commentary in isolation, you would say, okay, gloom and doom. But the silver lining here, and I mean, there is a silver lining here, is that if you look at the deal wins, what they've announced in the run-up to the earnings season, whether it's TCS or Infosys or even from HCL Tech, the deal pipelines are not bad. Now, typically when a deal for IT sector starts, it's a multi-year deal and it will have a multi-year transition. So it's not like a, get, set, go. So the deal will come in and it will be translated into multiple years. So what are we looking at? We are looking at FY24. The near-term estimates will be slashed. FY25, everybody will not talk about a bumper recovery because of the base effect. So you got to ask yourself that what is your time frame? Your time frame will now decide what your opinion on Infosys is. If you're a long-haul guys, look 3 years beyond, you will get Infosys. Infosys then becomes an attractive buy because the cyclicality will come back. If you're saying that, look, I've got a 6-month time frame, then Infosys, of course, is not going to surprise you. You got a today-tomorrow time frame, then of course Infosys is going to remain under pressure given the run-up what we have. So in the short term, under pressure. In the next 6 months, I think flat to no return. 1 year plus or 2 year plus, I think it will give you double-digit return because the sector will come back.
Yeah, and it seems like that's what brokerages as well are hinting, Nikunj, because across the board you've got the likes of Goldman Sachs, Jefferies, etc. They're maintaining their buy stance. They have said that it has been a negative quarter, no doubt, and they are, like you said, talking about the near term being weaker, but the long term potentially being stronger. So that's really the key takeaway when it comes to Infosys and HCL Tech as well. When it comes to the numbers, the management has cut the organic growth guidance to 4 to 5% versus 6 to 8%, but they are confident of an 18 to 19% operating margin. All right, IT numbers aside, let's put the spotlight on positive news on the macro front, because you've got the retail inflation for September. That's come in at a 3-month low of about 5%. And that's largely, Nikunj, on the back of the easing food prices. And even the RBI governor said that they have worked in close coordination to tackle the inflation problem.
Yeah, so this is like something which just exactly what the doctor ordered for the economy. I mean, inflation going from 7.5 coming down to 5, and the seasonality of the vegetable prices coming down, that just is a very big comforting factor. Now, the big comforting factor is that interest rates have peaked. If interest rates have peaked and inflation has peaked, that will give Reserve Bank of India a lot of elbow room in order to ensure that in the near term, the economy is coming back on the track. So this is something which I think will also help the bond market. Remember, post the RBI policy, then the new instrument what the Reserve Bank of India was using, the bond yields had almost gone to a one and a year high. So I think you will actually see a reaction of that really coming in. Inflation coming down also means, and this we are talking about food and inflation coming down just ahead of the festival season. It also is an indication that even if the festival demand is strong, let's say, for vegetables and for fruits and for, sugar, it is unlikely to have a very large impact per se in terms of the inflation trajectory. So inflation coming down, excellent news. I don't think markets are likely to react to it, but this is in terms of a narrative. It's a clear narrative that for the world, inflation is a problem and growth is a problem. But for India, inflation is coming under check, and growth is, in a sense, really stupendous now.
Yeah, absolutely. In fact, let's hear out what the governor as well had to say yesterday about the CPI print.
Effective coordination between the government and the Reserve Bank communication on interest rates, Reserve Bank communication on inflation. I think all these have worked together to ensure that the inflation, which again went up due to a spike in vegetable prices, government took several measures to see that the vegetable prices do moderate, and they have moderated. The latest print has come to 5%, and it is exactly in line with our internal projections. If I remember correctly, I think for the second quarter we had given out a number of 6.4%, and the second quarter number, inflation number, comes exactly at 6.4%. Our internal number for the month of September is also what it has finally come to be, 5%.
All right, good news on the inflation print. Let's chat levels on the index. Kunal Bothra and Naresh Mirani right here joining in. Kunal, is it going to be green, red, or just blue in terms of sentiment for the markets?
Absolutely. It's going to be blue in terms of market sentiment as well as in terms of World Cup. Now, on the indices, it's in the last couple of days, what we've seen is two different types of index movements. One, of course, was that sudden knee-jerk volatility which had come back into the indices, and then a steady build-up over the last 1 or 2 days where the index managed to come back about that 90,800 mark broadly on the spot levels. Now, interestingly, the only missing part over the last 2 days is the lack of follow-through for many of the large cap names as well as sectors. So I think if you look at it broadly, there's hardly any major comeback from those larger cap stocks on a more breakout basis, rather than any kind of a major recovery or follow through, which we tend to expect when the market gets into a trending mode. Also on the indices front, we've been trading into this range of 19,300 to 19,700. So I'm expecting that hopefully in the second half of the session today, if we see some bit of recovery and if we close above 19,700 mark on the spot levels, we would still maintain that bullish stance on the indices. So I think that's the important support to watch out for, especially after such a kind of a minor gap down opening of 150 plus points.
All right, Naresh, what is it that you're chanting apart from, of course, India winning when it comes to the markets?
So in terms of market, we are still finding this range, basically 19,300, 500 on the downside. Ideally, 19,500, 550 should hold on. And similarly, on the upper end, we are not able to sustain this 1970, 750, 19,800 mark. And also the fact that there are a lot of results over the next 2 weeks, which is where we'll see a lot of volatility, stock by stock, sector by sector. So focusing more on the mid caps and the broader end of the market. Overall, the bias still remains positive, but time to be more selective.
Okay, let's talk specific stocks as well. Naresh, what are you betting on?
So first, maintain a buy on GAIL India. The stock gave a breakout move yesterday above 124, 125. Good volumes, closed almost at the highest point of the day. Very close to a new 52-week high, as well as on a dividend-adjusted basis, it would be an all-time high. The stock is setting up for a much bigger move going forward. So a buy here with a stop loss at 124, target price of 145. Second is a buy on IndusInd Bank, which has been contracting this range at 1390 to 1470 and continues to be in this range. Once it sustains 1450, 1470, that would be a quick breakout move towards 1550, 1600. So for now, a preemptive buy here for a better risk reward. Stop loss at 1390, target price of 1550.
Let's talk some more stocks. Kunal, what's on your stock list?
So first is a buy on GAIL. That stock looking quite attractive on the short-term basis. In fact, on the short-term charts, stock is on the verge of a breakout, as well as on the longer-term basis about that 129 mark. So would suggest a buy 135 as a target. Stop loss I'm filling it hard to 124. And second is a buy on Vector Foods. Even this stock is looking attractive. Yesterday the stock closed almost at the high point of the day at 1160-70 mark. So expecting a follow-through up move, 1250 as a target, stop loss 1150.
All right, let's get in those top trading calls. Naresh, you did run us through your top recommendations. So just maybe get in a quick view as well as to how you're mapping out levels on the Nifty Bank Index.
So on the Bank Nifty, similarly, we found a better range, at least 43,500, 44,000 has held on. Now, the upper end, which will be tough one to cross, would be 45,000. So the new range going forward could be 44,000 to 45,000, a 1,000-pointer range. And in this period, once we start crossing 45,000, that is where the momentum shifts in a major way. But for now, it remains a buy on dips closer to 44,200.
You know, let's keep it with IT because that's what soured the sentiment yesterday and today as well. That's what's going to keep the focus on the markets, at least to start off trade with. A reaction coming in from both Infy as well as HCL Technologies. We discussed IT earnings a bit more with Rahul Jain as well. So let's hear out the commentary firstly from the managements of both Infy and HCL, and then we'll of course play the analyst bites too.
We see the impact in telecom, in high tech, in areas of financial services that we'd shared in the past. For example, payments, investment banking. We see some impacts in the retail sector as well. So those are the ones where we are seeing the impact. Of course, we have other industries, manufacturing, life sciences, which are continuing to do well.
So on the freshers, I think when last year we hired about 50,000 odd freshers, and in a way we hired ahead of sort of a demand predicted which we had. Now with that slowing down over this year, our utilization, as you saw, actually had fallen into the 70s, and therefore now slowly quarter on quarter you are seeing an improvement. So we still have a significant fresher bench. With us, we actually of course training them on new skills like Gen AI, SAP, etc. But we still have, a way on utilization to go. So at the moment, we are not going to the campuses as yet. And we will monitor this, every quarter, looking at our future projections and then accordingly decide when do we go back.
This quarter was definitely a very strong quarter across all dimensions of performance. Our revenues grew 1% sequentially and 3.4% year on year in constant currency. Looking ahead, the next 2 quarters, we expect a very healthy sequential organic growth in our services business. However, the market is still a little tepid on the discretionary spend. At the start of the year, we expected the discretionary spend would start coming back, partially at least, But with the continuing macros, the spending has not come back the way we expected. This quarter, as I announced, the telecom, media and entertainment segment has grown sequentially 6.2%, which is a very, very strong growth. We have no contribution from the strategic partnership that we have announced in Verizon, which is going to come from 1st of November as we had announced.
Rahul Jain joins us now, Vice President Research with Dollar Securities. Let's understand from him what he makes of the current market setup and how IT companies are likely to react to numbers. Rahul, first the howler from Infosys. It's almost like a no ball or a white ball, whichever term you want to use it. For second quarter now, Infosys has cut their guidance. One side they're talking about big deal wins, and then despite those deal wins, they have cut their FY24 guidance. Is this some kind of an indication of more pressure coming?
Yeah, I think the translation of order book not culminating into the revenue growth is more to do with a delayed start for the deals, and secondly, what we can call as a leaking bucket. So whatever 95% of the revenue that essentially come from your repeat customer, there are project completion which are not followed by the backfilling contracts, or there is sudden stop in the discretionary spend by some of the client versus what they were planning to deliver, commit to these vendors, and that's why you see back-to-back guidance cut. In fact, if you pick one of the comment which we saw was very stark in the TCS commentary, was that they said, forget next year, we see there's no visibility beyond a fortnight. And that is why you see a consistent miss on the guidance or growth because it's a highly hyper uncertain scenario.
So what's that miss, Rahul, going to spell out in terms of a stock move? Because most of these IT names actually recovered quite nicely from their 52-week lows. What happens now?
Yeah, I think from a large cap perspective, the absolute valuations were reasonable given the kind of a markets we are in, and that's why we see there was an opportunity. A lot of long-term investors were seeking into the large cap name, and that's where kind of a up move we saw during this quarter. Of course, the results are not adding any comfort, and that's why they are giving up some of this upside, which may continue for next few days as more result and more disappointment come in. We could see a severe cut today as well. I think the sharper moves have been more evident in the mid-cap names where the execution has been better on the relative basis. Of course, they are not very different from what the sector can deliver, and thus eventually we would see more pressure on those names versus the tier 1 names.
Large cap IT names, Rahul, especially the likes of Infosys, is the sense that it'll only be weaker in the near term and that potentially the long term will look stronger. And what do you think will lead to that growth?
Sorry, I could not gather the question.
Was talking about large cap IT in particular, the likes of Infosys. Do you think that it'll be weak in the near term and that long term it'll be potentially stronger growth? And what will lead to that stronger growth?
Yeah, I think there is a definite pain going into Q3 and Q4 also because some of this guidance are implying very muted performance, and generally H2 is weaker because of lower number of working days. From a confidence, from a longer term perspective, is essentially coming from strong TCV win. If you see for the 3 numbers that has been announced in this quarter, we have seen there is a strong TCV addition that is happening. So as long as the order signing are good, eventually the pain on the existing portfolio of customer or discretionary spends would pause at some point of time. And we could see these companies going back to their more sustainable growth zone, which is around 5 to 8% for the tier 1 and closer to 10 to 12% for the mid-tier names. So that may happen as long as the order book is healthy, which is the case in Q2.
Rahul, is there a reason where is there a case that we will see differentiated numbers from TCS, Infosys, Wipro and HCL Tech? Because now the difference between these top four, which normally followed a pattern, is now more and more stark.
Yeah, I mean, on a longer chart, we have always seen TCS and HCL Tech doing well on a 5-year, 10-year basis in the last 1 decade, and followed by Infosys, and much lower growth coming from TechM and Wipro. So far, the way the year is progressing, it's not very different. This time, of course, Infosys is looking more weaker in this particular year. But if you pick up from a 3-year basis, 5-year basis, I think that leaderboard of the growth trajectory organically is not very different. So HCL, TCS leading the growth in the tier 1 name, followed by Infi, and then Tech and Wipro after that. So that moreover remain intact so far.
So if you have to buy one stock in this decline, Rahul, out of the top four, TCS is giving you a comfort of growth but high valuations. Infosys is giving you uncertainty but it is attractive valuations, and Tech Mahindra to some extent is a promise on turnaround. Every case is separate. Which way should one lean?
So yes, I think you took 1 or 2 names which can be a better choice at this point. For example, Infosys, the absolute valuation are not expensive. They have 85% plus payout that they commit. So basically, if they go back to 6-7% types of growth, which looks like a possibility for next year, coupled with 2-3% INR depreciation and 3% types of dividend plus any other payout yields, still make a decent investment case for a 12-13% kind of a return if you look at from a 12 to 18 month perspective. So if your risk profile get aligned to that, then possibly that's a choice for you. As far as Tech Mahindra is concerned, given that the growth is pretty low, the margins are very, very weak, and the valuation are also very slow, there is a good possibility that with the change in the management over next several quarters, you may see a revival of growth and profitability eventually, and thus a re-rating would be imminent. So if you are looking for that, you should have at least have a 3-year horizon in your mind, because these are not going to be so simple ask, especially in this kind of an environment. So that's what I would like to position at this point.
Thanks so much for joining in, Rahul, and putting that into perspective, giving us a sense as to what the outlook is when it comes to IT. All right, on that note then, we'll take a quick breather then right here on the show. Do come right back. Lots of stocks and news lined up. Welcome back. Now, the RBI has taken action against BOB after the bank has accepted lapses in the linking of the mobile numbers to their app. ET now has learned from sources that the regulator verified various complaints from whistleblowers before taking action against the bank. Let's take it across to my colleague Ankur Mishra, who has the details. Ankur.
Yes, sources say that Reserve Bank of India action on Bank of Baroda has been taken after there has been several complaints regarding BOB World app. The allegations were that the mobile number linkage with the app was not proper, the process was not proper, and hence several whistleblowers had complained regarding the same, that there are few instances in some branches where the inflated numbers are there on the mobile app, which is BOB World, and hence the action needs to be taken after there were several checks and balances which were taken by the bank itself after these complaints surfaced. But the bank has acknowledged that there has been few lapses in the process of onboarding new customers. This was acknowledged when even regulator checked about the same, time, and after that the regulator has taken the action of onboarding new customers on mobile app. But just to clarify, the problem is limited to be in some branches only as per the inspection which has been carried out by the regulator. So moreover, the magnitude of the problem is not big, but since there are lapses in the process itself, the regulator wants the bank to have a robust process of onboarding new customers, and hence as this action has been taken, now bank is in discussion with the regulator for doing the same, and we may soon see that bank will reach out to Reserve Bank of India after the suggested changes in the process have been made.
Thanks so much, Ankur, for giving us those details. Shifting gears, let's hear out some top fundamental stock ideas. Here it are from Sanjeev Bhasin as he shares his views, as well as Chakri Lokpriya as he shares some of his top picks within the cement space.
We own PB Fintech, we own Zomato, and we own Paytm. We have not got into Nykaa given the extent of competition and margins being slightly on the lower side. But all those three stocks are under our coverage. We think PB Fintech can be a true outperformer along with Paytm. And given the underlying business, I think the overhang of most of SoftBank's holding is over with. Same is the case with Paytm, and Financial was a big key holder. They are now less than 10%. And I think that given the extent of the business updates and how these have become part of everyone's lifestyle, by Paytm and PB Fintech both can be very, very strong players in the coming couple of years.
Road building has actually slowed down, so an incremental demand from them for the cement industry will also clearly show up in the numbers. I think if you look at some of the north-based players, not the companies focused on the northern markets, they've managed to push through some pricing which the southern players have not. So against this context, but volumes are good, 14, 15 plus. Pricing is not great, but costs have come down. So against this background, Dalmia Bharat, JK Cement look good. I think UltraTech, being across the country, will face some kind of a pressure as far as in terms of not able to push through prices. Across the country, only in certain pockets it can push through. So it's Dalmia Bharat and JK Cement.
Okay, let's welcome on board Sandeep Sabharwal. By the way, the India-Pakistan fever, we're taking a little bit of a break from that. The match is tomorrow. Let's handle what the market is up to, because the GIFT Nifty is indicating quite a bit of a step back for us, about almost 145 points lower right now. Sandeep Sabharwal, hi, morning. I guess it's going to be IT, which is going to be the first thing that we're going to look out for. And it's quite, a little bit shocking that Infy for 2 consecutive quarters on the row has had to cut their guidance, and doesn't seem like they still have visibility on when things will improve for them.
Yeah, they don't. So I think many of the analysts are getting excited about the order bookings which these companies are doing, but they need to realize that many of these orders are 3 to 7 year kind of projects, and their start date in many times is also not fixed. So I think that's what has many analysts excited, and they are predicting that from next year growth will revive. Actually, if you look at the macroeconomic picture, the US Fed and central banks all around the world, I think India is very well placed that way relatively, are actually trying to slow the economic growth in order to control inflation in a sustainable manner. So trying to forecast that next year things will improve is a fallacious view in any case. So I think that's what is the issue. This is something which I've been pointing out for several months, that the growth visibility for IT companies is going to deteriorate. Discretionary spending is going to be cut even further. And it's some quarters away when actually we'll see the revival come through. Many of these companies have still been able to show some margin upticks because they have deferred wage hikes, variable pays, etc., which I think HCL and Infosys both announced that they'll be doing it this quarter. So I think that might be a further hit on their margins. So outlook doesn't look exciting at all.
Yeah, it doesn't look exciting at all. And, Sandeep, like in one of your tweets, you were mentioning that both Infosys, Reliance Industries, TCS, they're some of the, stocks which are most largely held by funds. And along with HDFC Bank, of course. And given the kind of stark underperformance in these stocks, one wonders as to what's going to happen and when, funds will sit up and take notice and make that adjustment.
So I think many of the funds will never make that adjustment, so they'll just wait out for things to change. And I think that gives the opportunity actually for people to outperform, because most of the larger funds, both on the large cap side and flexi cap etc. side, have Infosys, HDFC Bank, ICICI Bank, TCS, all these stocks as their top holdings, and so that actually also creates a question mark on the overall index performance. So I think just the index, because these stocks are such heavy overweights, that the probability that the index will do anything great also then reduces, and we have to look for stocks beyond the index and beyond the sort of comfort zone. And on the other hand, if you look at the economic picture, which data which came out yesterday, inflation fell much more than expected. IIP growth was much better than expected. So I think it's time to focus more on the domestic focus companies.
Okay, time to focus on domestic focused companies and market focused as well. Angel One, they've reported a very strong set of Q2 numbers. Let me take it across to Sharad and get in the details of the same. Sharad?
Well, yes, a very strong set of numbers coming in from the broking houses, and especially if you look at Angel One's numbers, sequentially we have taken the numbers, the revenues have also jumped by almost 29%. And if you look at the PAT numbers, that has also gone up by almost 38%. Now, of course, the numbers are coming in better than what the street was expecting, and the margins also has increased by roughly 200 basis points, coming in at 42%. Now, the important thing is the operational numbers. That is where the important numbers we can see. And the share in India's demat account, that has increased by 67 basis points, coming in at roughly 13.2%. And if you look at the total active user base, that has also gone up by 13%, coming in at almost 1.7 crore. Now, also the share in the NSE active clients, if you look at it, it's also up 27 basis points at almost 14.6%. And the share in the retail overall equity segment, that has also gone up by almost 26%, almost a 168 basis points, coming in at almost 26%. So we can see very strong operational update on a sequential basis as well as on a year-on-year basis. And the stock has also had a run-up recently as well.
Okay, Sharad, we'll leave it at that. Sandeep, that's been the very interesting trend, right? While demat accounts have also risen, the SIP inflows have risen, some of these market-focused companies are doing very well. I mean, be it AMCs, be it, platforms like Angel One, etc.
Yeah, so I think the performance of some of these companies actually has been very robust and also surprising to some extent, because the competitive intensity is quite significant. There are zero brokerage etc. companies, but I think some of these companies have done exceptionally well. AMCs went through a phase where for a few years their profits hardly grew when despite the assets growing, and because the cost increases and were happening, and the fee reductions mandated by the regulatory were playing on their overall profitability. But I think now they could be entering into a phase where the next few years could be 15-20% kind of earning growth. So they could become steady, stable return companies, and that's also resulted in some of these AMCs getting re-rated over the last few months.
Absolutely. Kunal, just a reading as to what you foresee now on the charts of Infi and HCL Technologies, a complete breakdown for the entire IT pack?
Well, I think as we were discussing yesterday, that many of these large cap IT stocks had gone through a steep rally for themselves from the September 2022 lows. Now, in the last couple of days, just prior to the results, specifically for TCS, the stock had started to show signs of some bit of fatigue. But then, the charts were not showing, or still not showing, any kind of a major breakdown or a reversal for these large cap IT names. Even I think TCS, for example, is still trading about 50-day moving average. Infosys still yesterday is trading about 50-day moving average. I'm assuming post results, on the reaction today. If the stock opens, say closer to 1350 odd mark, it could trade or hover come back to the 200 moving average. But again, when you try and look at this from the previous major supports of September 2022, these stocks have built in a lot of cushion for themselves. So it would still be higher by more than a margin of 10 to 12% from that 1200 lows for Infosys. So I would still believe that 1350 could actually be a decent support for the stock over the near term.
Okay, that's the take coming in on which way IT may be headed. Yesterday, of course, some of these metal names are the ones which were holding out well. So NMDC, clearly being one such case in point. In fact, Nuvama has come out with a note on NMDC. They're maintaining a buy here. They've upped the target price to 188 from the earlier 143. They're saying it's in a sweet spot to cater to the rising demand of ores with rising volumes and prices as well. Firm global prices have been a bonanza, they think, and driving up domestic iron ore prices over the past 2 months. So they're pretty gung-ho about the prospects of NMDC. Naresh, you want to come in on the charts of an NMDC, GAIL, NALCO? The entire PSU pack was abuzz, the energy sector per se.
So NMDC has been a trending stock right from 115, 120 levels. It takes a move, then takes a pause. So it moved up from 115 to 140, took a pause for a few sessions, again went up to 150. Then for the last 2-3 weeks, it was in a range of 140 to 150. We broke out yesterday. Interesting part is every time it has broken out, it has been on larger volume. So still looks promising. Any dips back to 150 to 155 would be a buying opportunity. Overall looks headed to 170, 180 levels. GAIL, on the other hand, is a fresh breakout. It just happened yesterday after consolidating for a really long time. And it has spent a long time after that breakout of 115, which was the high in 2021 and 2022, almost 4 to 5 times. Then made a new base at 115 to 120, then a new base at 120 to 130. Yesterday gave a breakout, very large volumes compared to the last 2 months. So that's another stock which looks promising. This could actually be a start of a much bigger trend on GAIL India. It could go all the way to 150, 170 levels also. So these two names, GAIL India looks the most promising.
Okay. Now what do I have on my radar? Well, it's SBI. Why? Because UBS is the first big foreign brokerage house which has come out with a change of heart, if I may say so, for SBI. According to UBS, most of the return ratios for SBI are actually peaking out now. And they've downgraded SBI from a buy to sell because UBS feels that their return ratios in terms of NIMs, in terms of the advantage of lower interest rate, in terms of the first advantage which banks get when interest rates they move out, and also the growth in some of the subsidiaries is something which is priced in. SBI may have underperformed this year, but from the COVID low, SBI has been a ranked outperformer. And even though some may argue back, according to UBS, that valuations on a net basis for the banking business is strong, but given that there could be challenges ahead in terms of how the economy would move, how the SME sector would move, how growth is going to move, SBI, according to UBS, could actually be a stock where you should be selling it rather than buying it. So it's a big change of heart for the first time and first major downgrade on SBI, which has come from any big brokerage, at least in this year. Sandeep, I must admit that I've always been an SBI bull because I'm fascinated with what they've done, not only in terms of managing their branch network, also in terms of digital, Do you think one should get slightly myopic and look at NIMs and pressures on retail spreads and get bearish on the stock, or SBI is something which will continue to surprise us?
NIM compression has been known. It is something which is out in the open and everyone knows that there is going to be NIM compression. Now, the extent of NIM compression is what we should be worried about, if at all. Now, in my view, among the PSU banks, SBI will have the lowest NIM compression given their huge CASA book and which continues to grow unlike many of the other PSU banks where that's more under pressure. So I think I'm not very sure about all these logics which have been given. So I don't own SBI at this stage because I prefer ICICI or Axis Bank. But I think all the logics which have been given seem to be very flawed.
Okay, that's the take coming in on SBI. Kunal, would you also pick on an Axis, ICICI Bank versus SBI? Is that what the charts are also hinting towards?
Yeah, I would probably prefer ICICI Bank out of the names which you mentioned. I think that's a stock which looks more attractive in terms of the risk reward, the short-term positioning of the stock at 930 odd levels, 920 odd levels when the stock formed a bottom for itself, a triple divergence on the hourly charts, and then a pickup of price action from those 920 odd levels to I think 950, 55 with the stock close yesterday. So that's a more attractive chart. Axis Bank had given that breakout about 1000 levels, but the stock seems to be struggling at 1040 kind of a trading range. There is excess amount of volatility and no major signs of stability which is coming back into the stock price. And I think more or less similar for SBI. It's just that SBI has not given that breakout about that 620, 630 mark, which is the previous life highs.
Okay. SBI is something which UBS has come out with a report there. Let's now turn our focus and move on to, well, the entire banking space. Sandeep, one would argue and say that SBI, the banking space is due for its comeback. Numbers are not going to be bad. The stocks, in a sense, have underperformed and consolidated.
Yeah, Nikunj, the only thing I will be watching out for will be if there is any uptick in the entire NPA cycle and whether NPA start picking up, because a lot of the profit growth of the last 2 years, one, there was NIM expansion, of course. The second part was because the write-offs were reducing so much and then there were recoveries. So I think all that was contributing to the profit growth. Now, a large part of that is behind us. Now, if NPAs remain stable, then I think we'll see many of these banks come back and revive. But wherever we see small upticks in NPAs, I think their investors will become concerned. So I think that will be the critical thing to watch over this quarter and the following quarters.
Okay. Sun Pharma, they've undertaken the phase 4 trial shows, which has actually shown an improvement in dry eye disease patients. So that's going to be one stock which is going to be in focus. Lupin has got a US FDA nod for one of their generic oral solutions. So look out for that stock as well. On the other hand, though, Dr. Reddy's, the US FDA has issued 9 observations for their Hyderabad manufacturing facility. So that stock may be soured in trade, unlike the other two. That said, we've been highlighting how some of the earnings, while it may be soured for the IT pack, but for some of the market-related companies, that's been very strong, be it Angel One, wherein the gross client acquisition has come up almost 60% and the revenue has risen nearly 30% on a sequential basis. For Anand Rathi Wealth as well, and we're going to be chatting with the management as well in the due course of the show. The AUMs have come in higher by 10% on a sequential basis. They've also raised their FY24 AUM and revenue guidance. So very, very strong performance coming in there. Naresh, I want to get you in on the charts of both Angel One as well as Anand Rathi, if you've taken a look at all.
So Anand Rathi has been in a one-way trend, so the risk reward is not great, but Angel One is very interesting. The stock peaked out around closer to this 1950-2000 mark back in the start of 2022, corrected all the way to 1000. So it was almost a 50% drop for the stock. A couple of times it had made a recovery also in between to 1600, again back to 1000. So it made 3-4 bottoms around 1000 and slowly started trending up from March end. And out here, the stock came back to 1950. And for the last 1 month, it was consolidating and then broke out about this 1950-2000 mark. So ideally, such a breakout should give an upside towards 2400 odd levels on a minimum case. We broke out about 2000. We've sustained for the last 3-4 sessions on the stock. And post numbers coming from yesterday, today could be a move towards 2400 in the short to medium term. So closer to 2100, 2150, it's still a buy.
Okay. Meantime, Sandeep, wanted to get in your thoughts on the entire metals basket, given that we have seen, firmed global prices as well. That has been quite a, benefit for most of these companies. What's the view within this sector?
So I think, Avan, these are more trading kind of bets. So there'll be short-term moves in these stocks because as prices move up from bottomed out levels, etc. But looking at the global macroeconomic picture and especially China outlook, I don't see a runaway rally happening in metals and as such in metal stocks. So I think people have to play it this way. There will be trading rallies. If you make decent money, just exit them.
Okay, fair enough. Meantime, Kunal, let's get in your take on the metals basket. Where does your preference lie?
Well, I'll still go with the likes of Hindalco as the first preferred stock from the pack. JSW Steel somehow in the last I think 2-3 months has been struggling as such. I think the stock has been hovering around the 780 odd mark, corrected from that 850 odd levels some time back. And that stock is taking its own time to try and get into recovery. Tata Steel is something which has still been one of the stock which has not given a huge breakout of sorts. It's been an underperformer. I think 125, 130 looks to be a range for Tata Steel as well. So we'll wait for a breakout above 130, 132 mark for Tata Steel to get into a momentum zone. As of now, Hindalco is something which looks attractive from the entire metal pack.
All right. In the meantime, let's also get in views then, Sandeep, as to what you're penciling in when it comes to HDFC Bank. Come Monday, it'll be the first time that the merged entity will be declaring its numbers. And the expectation is that we could see a profit of about 14,800 odd crores. We'll be watching for a contraction this time around in the margins. The asset quality could be flat versus the merged entity numbers that had been disclosed. What is it that you think the street will closely monitor?
I think these are the two things which you talked of. One is what is the NIM compression going to be and whether it's going to accelerate going forward or stabilize. And secondly, what's the NPA figure that gets reported and the trends in that. I think these are the two critical figures for the merged HDFC entity. So any improvement in these parameters will lead to the stock doing well. Any deterioration could lead to this prolonged underperformance, which has been in for the last 2-3 years, continue for some more time.
Meantime, Naresh, let's get in a view then on the charts of GAIL. What's the outlook in terms of the kind of breakout that we witnessed on the charts? And have you had a look at Indus-Star as well, which has seen a pretty strong up move?
So GAIL India looks very promising in terms of a technical chart structure. The stock had topped out around this 130 to 135 mark back in 2018, and it had topped out around 115 mark in 2021 to 2023. So the first breakout got done. We consolidated, went up to 120, then consolidated between 120 to 130, and now is setting up for a move towards an all-time high. And that could be start of a much bigger uptrend out here. So at current levels as well as on dips, GAIL looks promising. Could be start of a multi-month trend out here. So that's the one which I continue to like. Industars is another interesting stock. For the last 1 month, it has made 4 tops around that 195 to 197 mark, and almost 3 bottoms around 178 odd levels. So it's a tight range right now. 4 attempts done on both the sides. If it's sustained above 197, we could see a move towards 220 on that one also.
All right, fair enough. Meantime, just, mapping out the kind of move that we've seen from last week and what we've seen from those recent highs as well. You've got the realty index, in fact, from those 4th October lows that has gained about 8.7%. And clearly, it's been the cynosure of all eyes, the kind of move that we've seen. And it seems to be synchronized, Sandeep, within the entire real estate space. What's looking good here?
Yeah, it's been an extraordinary number of numbers. The numbers reported on a pre-sale, whatever pre-booking basis for real estate companies across the board have been actually very surprising to me. Also, the kind of strength it still sustains after interest rates have also moved up. So I think for people who want to take a lower risk, they need to stick with the larger players like something like a DLF, Godrej Properties, etc. And for people willing to take more risk, I think there are a large number of listed real estate companies. But historically, we've seen these companies get into trouble every time there's a downtick. So I think we need to be very careful about that.
What about your outlook then, Naresh, when it comes to some of these FMCG counters? The FMCG index hitting a 2-month high yesterday, and names like United Breweries, for instance, or Radico as well gaining traction.
So a lot of these names have gone sideways now. So Radico Khaitan corrected from 1500 odd, 1450, 1500 odd levels to 1150. Has made a minor pullback but overall looks sideways. Same is the case with United Breweries, which has made multiple attempts to make a start, but every time it goes closer to 1700, 1750, it flops. So out here, very recently also tried to make a move, again corrected. So out here sideways for a long period of time now. The stock used to be at 1550, 1600 even for majority of 2021, 2022. So till the time it doesn't cross 1750, it looks sideways.
All right, what we'll be watching out for in trade today, apart from, of course, the numbers from HCL Tech and Infosys, is going to be a Kesoram Industries, for instance. It was a continued loss that they delivered in the quarter gone by at 58.3 crore rupees. You also had the EBITDA, which came in higher by about 32%, and revenue growth was steady at about 950 odd crores. Angel One is the other one that the street will closely keep an eye out on. Maybe the margins decline, but otherwise, on the other metrics, it's been fairly decent. A 40% revenue growth, and you've also got the overall net profits, which came in at 3,045 crores, up about 42%. Anand Rathi is the other result candidate that the street will monitor. So at 77 crore rupee EBITDA, it's been a 14% bump up. You've got the revenues as well that have scaled, and net profits at 57 crores have grown about 34%. Let's get in some cues then from you, Kunal, on the charts. Angel One, Anand Rathi?
Well, I think many of these brokerage stocks have started to look very, very attractive. In fact, Angel One is something which I do track very closely, and the stock has given a very good breakout about 2000, 2100 levels. In fact, on the month till date chart, the stock is up 14.5%. In the last 3 or 4 months, the stock has scaled from 1500 to now 2100 plus mark. That's a decent return of more than 30% for the stock in just the last 3 odd months. And then the same criteria happens on or intensifies for Angel One on the longer term basis. So I think that's a clear sign of a breakout. The stock breaking past about 2100 levels, which was also the previous high, I think 2022 start, is another indication that this could be a start of a decent medium to long term uptrend for Angel One and not be a short term uptrend. So would be bullish on the stock specifically out of the many of the other brokerage firms still listed.
All right, Sandeep, before we let you go, what would be your top 3 mid-cap recommendations?
That's a tough one. 3 recommendations.
Okay, give me one at least.
So I think among the stocks, I think are on the value zone on the consumer side. I would think something like a Voltas and Aditya Birla Retail. I think these two are the ones which we are accumulating on every day, because I think the downside is limited. Near-term upside, I'm not very sure, but I think over the next 1.5 year, we should be able to get 25-30% out of these.
All right. Thanks so much then, Sandeep, for joining in and sharing with us your outlook on the markets. A quick check-in. What's the pre-open rate indicating? No surprises for seeing a tick of red on the screen at 19,640 levels. That's down nearly 1%, far more measured in terms of the fall for the Sensex, at least as the initial rates kick in. Let's find out what the mid-cap strategies are. And Kunal, what's on your radar today?
So out of the mid-cap list, I would be bullish on one of the stocks which I mentioned even couple of days back. That's Atul Limited. That's a stock which I think is now forming a bottom at the 6,800, 850 odd mark. So keeping 6,800 as a stop loss would suggest a buy with 7,250 as a near-term target.
All right, that's Atul Limited that Kunal is watching out for. Let's get in your top trading strategy within the mid-caps, Naresh.
So that will be a buy on CRISIL Limited. The stock has given a breakout and closed around the breakout levels only for the last 3 sessions. A very tight range for the last 4 months between 3,800 to 4,050, 4,100 levels, closed around 4,000. So a good risk reward trade here. Volumes have picked up. So stop loss at 3,850, target price of 4,500.
All right, let's move right on then. Lots of other top headlines to track, and the Israeli forces have continued to attack the Gaza Strip, preparing for a possible ground invasion as the conflict with Hamas continues. Over 3,000 people have been killed on both sides. The Israeli Prime Minister has warned of difficult days ahead. Meanwhile, in a show of support, the U.S. Defense Secretary Lloyd Austin will be reaching Israel today. Meantime, India has brought back nationals from the war-ridden Israel under Operation Ajay. The first flight with 212 Indians, including an infant, landed in the national capital today. The Union Minister Rajiv Chandrasekhar was present at the airport and received the Indian nationals who arrived from Israel. Meantime, Delhi NCR is gearing up for winters, which also means fighting stubble burning, fumes and pollution. After Haryana and Punjab, the capital now has stepped up its efforts to stubble burning. The Delhi government has launched a drive to spray biodecomposers in the paddy fields in an attempt to turn straw into compost without any pollution. And today the nation is going to be celebrating National Cinema Day. It's a special occasion to recognize the profound importance of cinema in our society. In a delightful treat for movie enthusiasts, tickets will be available at an affordable price of as low as 99 rupees, making the magic of the big screen accessible to all. Over 4,000 screens will be participating in the festival, including the big multiplex chains like Inox, PVR, Cinepolis and many more. All right, in time for Khabar on D Street, MRPL in the spotlight. The refinery has recently concluded the revamp of its benzene plant. The company is expected to face some short-term headwinds. Let's get in Sharad, who joins in with the Khabar. Sharad.
Well, yes, in focus we are having MRPL, and the buzz is that the benzene PX, which is the paraxylene plants, have actually done a revamp. Now, after the revamp and the maintenance, is expected that the overall utilizations of this plant is expected to increase by more than 200 basis points, coming in roughly 94%. Now, this plant can produce both these products and based on the demand and supply dynamics, and has a capacity of 1.2 million tons per annum. Importantly, also the company is looking out in the process of identifying small petchem projects for acquisition, and a larger acquisition is also in the fray when it comes with ONGC. Now, overall, the balance sheets might get stretched. That's what the street is fearing, and there is also a short-term headwinds coming in, especially because of the declining GRMs. A decline of $1 per barrel of GRM is expected to impact the EBITDA by roughly 1,000 odd crore rupees. Also, the street is concerned, especially on the sustainability of the strong GRMs as well as the demand.
Okay, thanks very much for running us through all that Khabar then on D Street. We'll be watching out for that stock in trade. But there's also SBI that will be in the spotlight, and let's get in a quick take from Nikunj as to what he makes of the UBS downgrade on SBI, given that that has been one of the biggest downgrades that we've seen in a while.
Well, it's SBI. Why? Because UBS is the first big foreign brokerage house which has come out with a change of heart, if I may say so, for SBI. According to UBS, most of the return ratios for SBI are actually peaking out now. And they've downgraded SBI from a buy to sell, because UBS feels that their return ratios in terms of NIMs, in terms of the advantage of lower interest rate, in terms of the first advantage which banks get when interest rates they move out, and also the growth in some of the subsidiaries is something which is priced in. SBI may have underperformed this year, but from the COVID low, SBI has been a ranked outperformer. And even though some may argue back, according to UBS, that valuations on a net basis for the banking business is strong, but given that there could be challenges ahead in terms of how the economy would move, how the SME sector would move, how growth is going to move, SBI, according to UBS, could actually be a stock where you should be selling it rather than buying it. So it's a big change of heart for the first time, and first major downgrade on SBI, which has come from any big brokerage, at least in this year.
Okay, that's the take on SBI. Maybe some weakness coming in on that stock today on account of the brokerage downgrade coming in. Let's revisit, in fact, not just SBI, but what rest of the IT pack is doing, because starting off with Infi, TCS, and maybe that weakness, even though it was a decent set from HCL Technology, a bit of a mixed bag at that. Almost 4.5% lower on Infi right now. HCL Technologies as well getting rubbed off and dragged lower, 1% lower on that one. And the entire IT pack would be the same. But Kunal, given that the pre-open, the GIFT Nifty is indicating a bit of a step back for us, what is this level of 19,650 mean, considering the swift pace rally that we've had from Tuesday up until day before?
So I'll look at it this way, Aisha, that the markets are not yet ready for a breakout or a breakdown. Now, even after I think 2 days or 3 days back, when there was a lot of geopolitical news flow, rather start of this week, we came very close towards that 90,300, 300, 400 levels, but then we've managed to protect those points for the indices. Now, after the last 2 days, specifically the results reaction for TCS yesterday and today post the results reaction, I would probably expect that the markets are still getting settled into a trading range. So I think this whiffs of an indication gives a whiffs of an indication that the markets are still not ready for any kind of a major breakout or breakdown. We would probably meander around the 50-day moving average for another couple of days in case if there is any kind of a negative surprise which comes across for many of the other larger cap names. Only then we would probably expect some sort of a breakdown or maybe a retest of the 90,300 mark. So as of now, not expecting any major trend on the indices except for a consolidation into this 300-400 point band.
Naresh, besides IT, what's looking like a weak link? What do you think will drag markets lower other than IT today?
So it could be a little bit of a correction in the banks, which we've seen some bit of a downgrade. So some bit of a correction in an Axis Bank or SBI, but the main weakening continues to be the IT pack. Apart from that, we are seeing sideways move in majority of the sectors. We've seen a mild pullback in FMCG. We've not seen a major runway in banks as such. PSUs on the other hand have been positive. So no major weak links, more of a sideways trend in majority of the names. Even the heavyweights like Reliance Industries or HDFC Bank continue to be sideways.
Okay, fair enough. Meantime, let's also get in some thoughts on yesterday's drags in the session. And you had the likes of a Tata Consumer, something like an Asian Paints as well that felt the heat. Kunal, comment on the charts of these names.
So I think out of the names which you've mentioned, Tata Consumer is something which actually looks very attractive on the charts because that's a stock which I would believe has been one of the more resilient names from the entire FMCG space. I think if I'm not wrong, many of the other FMCG stocks like HUL, Britannia, etc., these stocks had fallen by a margin of 15% odd from their June or July highs, 2023 highs. These stocks, they came closer to retesting their long-term moving averages, and then slowly and steadily we saw a bounce or a mild rally shipping up into these stocks. So I would believe Tata Consumers is more resilient one because that stock had not shown any major correction. It's still due for a breakout about the 920, 940 mark, which has been a resistance of sorts for Tata Consumers. But I think it could just be a matter of time that the stock may provide that kind of a breakout. So would be bullish on Tata Consumers.
Okay, that's the take coming in on Tata Consumers right now. Naresh, do you sense that, it's going to be a blanket red on the screen today, or do you think there could be some sector or sectors which could be resilient in the fall today?
So I would expect the index weights like first IT to remain down through the day, some bit of banking to remain more flatter than not see a more than a 1.5% correction in a lot of those names. The only positive side could be gas companies which have given a breakout. Something like a GAIL India, IGL was up yesterday, MGL was there. So public sector enterprises could be doing better. So that could be the space, a little bit of a bounce in FMCG. But overall, most of the impact should come from IT. The rest of the names could be in a very small range for the day.
All right, let's move right on and find out what those index calls are, as well as we're just about a couple of minutes to the market open this morning, bracing ourselves for a somewhat unstable or shaky start owing to the rest of the globe. There you have it. 3 experts, 3 calls that are exactly the same, a hold view on the Nifty index. Do remember in yesterday's trading day as well, it was a flattish day of trade. For now, the pre-open rates are indicating that it could be a wobbly start. So therefore, the consensus call on the Nifty is a hold. What is the advice that our chartists are tracking on the Nifty Bank? Well, it looks like it's a hold call there too. The Nifty Bank index, that's the view on the market moodometer.
left to go before we actually ring the opening bell for this Friday. And we're stepping back, of course, today. And, come to think of it, this has been such a hugely volatile week, this one. On Monday, you started off with weakness. Tuesday, Wednesday, a one-way, very, very steep comeback for the markets. Consolidation yesterday, and today we're going to be pegged back. Although Kunal still believes that, the Nifty is in no mood to give a breakout or a breakdown. So maybe we're going to just, circle around maybe Monday's lows or so. 19,650 is the print that the pre-open rates have settled in at and are indicating. IT, of course, is going to be the big sour point and the drag point today. So continue to look out for that. While, TCS's commentary was don't expect Q3 to be a strong quarter. Infi has actually cut the upper end of the guidance from 1 to 2.5% versus 1.3.5% earlier. They're saying discretionary spends and decision making has reduced significantly. Digital program and discretionary spends are being reduced or stopped, and some deal ramp ups they're saying are timed at the back end of the year. So clearly indicating that second half is also not going to showcase a very meaningful recovery, and more importantly, the picture continues to be hazy. There's no clear indicative timeline on when the recovery is going to really be, even at a time when both TCS, Infosys and some of the other large IT names have actually bagged some mega deal wins. So while deal wins continue strong, you're not really seeing any conviction from the IT names on when the business recovery overall is going to really pan out. So Infi has actually gone on to even say that they don't think they're going to go to campuses this year. HCL, on the other hand, has been not all that bad per se. The organic growth guidance, while it has been cut to 4 to 5% from the earlier 6 to 8%, the same market is still tepid on discretionary spends, but they expect healthy sequential growth over the next 2 years. So there come the first rates then, and clearly it's going to be all about earnings reactions given the kind of fall that you had in the Infi ADR overnight. While it's a 0.6% cut, 3.5% is the drag that you're seeing for Infosys alone. 14.15 is where that stock is. What's the case with HCL Technologies? Is there a further fall in TCS after yesterday's move? And I can see a whole lot of red across the IT screen right now. While HCL is actually jumping up 0.7%, TCS is dragging a little bit further, circling around that 35-30 odd level in trade. Wipro as well starts off in the red as we speak right now. SBI, after that brokerage downgrade, that stock also is seeing a bit of red. Let's just bring up that stock for you on your screens right now, because that too, after the downgrade coming in on SBI to a sell now, has started off in the red as we speak right now. So that's the key main stocks which are going to be in focus this morning. Now let's talk about some of the winners. Nuvama maintains their buy on NMDC. They've upped the target price to 188 from the earlier 143. Remember, these were big breakout stocks in trade yesterday. Today, it's a lot more tempered across that screen. What about Nalco, Gale? These were the other names. Bosch, PVR, Inox. These were all which held out. Coal India saw a very decent move. NTPC, BPCL, these were all green ticks in yesterday's session. Some of them are continuing to maintain their green. Let's also talk about some of the pharma news flow. So Sun Pharma, Lupin in the green perhaps, because for Sun Pharma, the phase 4 trials are showing improvement in dry eye disease patients. Lupin has got a US FDA tentative nod for one of the oral solutions, a generic one at that. So relatively resilient in an otherwise weak market. Flat for Lupin as we speak, although DRL has had negative news flow. US FDA has issued 9 observations for their manufacturing facility in Hyderabad. So look out for that, what that stock does. Angel One, Anand Rathi. Those could be the big movers this morning, given very strong performance from there. Angel One has gapped up 3.6%, not seeing material excitement for Anand Rathi, although the AUMs have risen up 10% there sequentially. They've raised their FY24 AUM and revenue guidance as well. And for Angel One as well, the gross client acquisition has come in higher by nearly 60% on a sequential basis, and the revenue as well has seen an uptick of nearly about 30%. Paytm Payments Bank has been fined just a very small amount, but fined regardless by the RBI on regulatory compliance issues. So look out for what that stock as well does in trade. 1% lower on that one. I'm almost rubbing my eyes in disbelief. Are we seeing a big recovery in IT? TCS is actually in the green, 0.5% higher right now. Let's see what Infi is up to. TCS has covered all of its losses. HCL Tech is powering up ahead. 2.25% in the green for HCL Technologies. And even for Infi, that gap down is actually getting bought into, because that too has actually recovered nearly about 2% from its opening lows. 1431 is where Infi is right now in trade. So Kunal, firstly a word on IT, because it's really not all that bad as one thought it to be.
So yes, Aisha, I think it's a good recovery. 2% down for Infosys, 0.5% down, or for the other names, 3.5% or rather 3% up for HCL Tech. I think we would probably call this as a not so negative reaction for the IT index so far. And the good part is that many of the large cap IT names are still trading above their key moving averages. So I would expect that the markets have now probably built in a more of a absorption capacity to try and absorb the negativity in terms of results. This could actually be a good sign for the overall IT index. So would wait out for at least the first couple of hours, and if these stocks show signs of stability as well as more upside momentum, I think that's where one would probably look to trade on the upside. In terms of opening trade, DLF is something which looks attractive, and that's a stock which I believe did pretty well a couple of days back, had muted price action yesterday, could be bought into today as well.
All right, let's find out what Naresh makes of the trade setup this morning. And Naresh, lackluster, IT seeing a comeback, broader markets pretty quiet. What are you making of the initial trading ticks, and what would be your first trade?
So a much better tick as such. We've not seen a much larger dip of 150, 200 points. The first trade continues to be the same, looking at IndusInd Bank as an accumulate slowly and add on the way up.
Right, okay, that's the take coming in from both of our chartists on which way the trading day is going to pan out ahead, and it's really not all that bad.